Welcome back to TradeGlow FX. In today's video, we're trading gold. Let's break down the setup. Gold has been in a sharp downtrend on the lower time frames. After this extended move, price approached a major support zone where we've seen multiple rejections in the past, around the 3,343 level. Now here's where things get interesting. On the 5-minute chart, a hammer candle has just formed at this support zone. That's an immediate clue of buyer presence, signaling exhaustion in the selling pressure. We've marked our entry at 3,347.189, right above the wick high of the hammer, because if buyers step in, they'll likely break that level and trigger a short-term reversal. Our stop loss is set just below the candle at 3,343.959. We're giving this trade some breathing room, but not too much to risk capital unnecessarily. Target is placed at 3,351.404 near the minor resistance where sellers last rejected. This gives us a proper risk-to-reward ratio of 1 to 1.5 plus. So now, gold is testing the breakout level again. And yes, our entry is now triggered. We're seeing initial movement into profits ranging between 500 to 1,000 rupees. It's a slow move, but that's exactly what we want. Controlled and steady price action. Now here's the logic again, just to reinforce it. First is major support zone, then second hammer candle confirmation. Third, aggressive stop loss placement under structure. Fourth, clear breakout levels tested multiple times, and all these things combined make this a high probability setup. Look at how gold is behaving right now. We're seeing bullish candles with higher lows starting to form after our entry. This tells us one important thing. Short sellers are exiting, and new buyers are stepping in. This is typical breakout psychology. When the market falls too fast and hits a strong demand zone, early shorts start to book profits. That reduction in selling pressure, combined with new long entries, creates the momentum for a reversal. Also, the hammer candle is not just a candle, it's a psychological footprint. It shows that bears tried to push lower, but bulls absorbed the selling pressure and closed strong. This is why we placed our stop loss just beneath that wick. If price closes below it, it invalidates our trade. But right now, price is holding. The breakout is clean. Structure is solid. Momentum is shifting. Let's quickly talk about the risk management we used in this trade. Our total trading capital is around 13 lakh rupees. But in this trade, we've deployed only 1.5 lakhs rupees, which is around 11.5% of our total capital. This trade carries a max risk of around 20,000 to 30,000 rupees, which comes down to a 2% capital risk. And that's completely acceptable as per our rulebook. Why is this important? Because survival comes before profitability. You can't scale in trading if your capital isn't protected. We never risk more than 1 to 2% per trade, regardless of how confident we are. Even if we face losses, they are controlled, calculated, and within boundaries. This is the difference between professional and emotional trading. Let's take a look back at the chart now. We've got a solid bullish candle forming above our entry. That's a good sign. If this candle closes strong, it could invite momentum buyers and bring in institutional volume on the next leg up. We're not chasing the market. We're just waiting for our levels to get respected. Patience here is key. It's very tempting to book small profits when you're slightly green. But remember, don't focus on the profit. Focus on the process. Let the trade play out. Follow your plan. Trust your setup. We're holding strong. Now let's address something very important. One common mistake retail traders make is exiting too early out of fear or greed. You see a 2,000 rupee profit and close the position, but your plan had room for 10,000 rupees plus. That's not discipline. That's emotional reaction. We always follow system-based trading. That means we place our stop loss and target orders in the system and let them get hit automatically. No manual interference. No panic exit. No revenge trades. This approach builds discipline over time. It also removes decision fatigue from trading, so you focus on what matters. Reading price, not chasing it. And now, take a look at that candle. Absolutely beautiful price action. Clean breakout, strong structure. Yes, target hit. We've successfully booked a 37,900 rupee profit on this trade. This is the type of setup we look for every day. Not frequent, but high quality. Before we wrap up, here are the core takeaways from this trade. Trade only at strong demand and supply zones. Wait for price action confirmation, hammer, engulfing, etc. Place stop loss strategically, below, above structure, not random use. Fixed capital exposure, avoid over-leveraging. Always have a clear risk-reward plan, no emotional decisions. Don't chase, let price come to you. This exact trade setup was also shared in our free Telegram. To join the channel, check the link in the description and join. Thanks for watching. If you learned something valuable, make sure to drop a like, share this video with serious traders, and drop your thoughts in the comments. We'll see you in the next one. Until then, stay sharp, stay focused, and trade with discipline.